One of the prevalent misconceptions perpetuated by banks is the notion that our money grows in our bank accounts. The reality, however, is that while the numerical value of our money may increase due to interest, its actual worth and purchasing power diminish over time, especially when faced with escalating inflation rates. In this video, we aim to elucidate 6 assets that can shield against this wealth erosion, fostering the creation of intergenerational prosperity. First on the list is precious metals, gold, silver, and platinum ***. A crucial factor in the consideration of money's value lies in its ability to store wealth for the future. Unfortunately, with governments incessantly printing currency to cover deficits, the reliability of traditional currencies diminishes. This uncertainty underscores the importance of allocating a portion of one's portfolio to precious metals. Gold, silver, and platinum, being scarce and resistant to easy replication, consistently appreciate in value. Prior to the 1950s, an ounce of gold cost around $400. By 2023, the same ounce is valued at over $2,000. Projections indicate a potential rise to $10,000 by 2032, making gold a resilient investment against inflation. Investing in precious metals serves as a strategy to counteract the devaluation of cash over time, aligning with the approach adopted by many affluent individuals. Our number 2 asset is gold ETFs. For those seeking exposure to gold in their portfolios without acquiring physical gold, gold exchange-traded funds, ETFs, present a viable solution. These investment vehicles offer a cost-effective means of gaining returns based on gold price movements, eliminating the need to possess physical gold. Gold exchange-traded funds, ETFs, are investment vehicles that offer a convenient and cost-effective way for investors to gain exposure to the price movements of gold without physically owning the precious metal. What is a gold ETF? A gold ETF is a type of exchange-traded fund that tracks the price of gold. These funds are traded on stock exchanges, and their value is linked to the performance of gold, usually measured in terms of gold bullion prices. The goal is to provide investors with a simple and efficient way to invest in gold without the complexities of owning and storing physical gold. How gold ETFs work: backing by physical gold. Gold ETFs are typically backed by physical gold, and each unit of the ETF represents a certain fraction of an ounce of gold. The fund holds the actual gold in secure vaults. Step 1. Authorized participants, usually large financial institutions, create and redeem ETF shares in large blocks, known as creation units. This process helps keep the ETF's share price in line with the actual value of the underlying gold. Step 2. Gold ETFs are traded on stock exchanges like individual stocks. Investors can buy or sell shares throughout the trading day at market prices, providing liquidity. Advantages of gold ETFs: ease of access. Gold ETFs offer a convenient way for investors to gain exposure to the price of gold without having to buy and store physical gold. Liquidity. Being traded on stock exchanges, gold ETFs provide liquidity, allowing investors to enter or exit positions easily. Cost-effective. Compared to buying and storing physical gold, investing in gold ETFs is often more cost-effective. Investors avoid expenses related to storage, insurance, and potential transaction costs associated with physical gold. Diversification. Gold ETFs enable investors to diversify their portfolios by adding exposure to a commodity that may act as a hedge against economic uncertainties and inflation. What are some of the risks and considerations? Number 1. Market risk. The value of gold. ETFs is directly tied to the price of gold, and like any investment, it is subject to market fluctuations. Number 2. Expense ratios. While generally cost-effective, investors should be aware of the expense ratio, which covers the fund's operational costs. Lower expense ratios are preferable. Number 3. Tracking error. Some ETFs may have a tracking error, which is the difference between the ETF's performance and the actual performance of the underlying gold. Popular gold ETFs, Spider Gold Shares, GLD. One of the largest and most well-known gold ETFs, it holds physical gold bars in vaults in London. Shares Gold Trust, IAU. Backed by physical gold, this ETF is known for its low expense ratio. Granite Shares Gold Trust, BR. Features a lower expense ratio and holds gold in vaults in London. Tax implications, capital gains. Tax profits from the sale of gold. ETFs are generally subject to capital gains tax. Tax implications may vary based on individual circumstances and local regulations. Gold ETFs provide investors with a flexible and efficient way to include gold in their investment portfolios. Whether used as a hedge against inflation or a diversification strategy, gold ETFs offer a liquid and accessible avenue for those seeking exposure to the precious metal. Investors considering gold ETFs should conduct thorough research, understand the specific features of the chosen ETF, and consider their investment goals and risk tolerance before making decisions. Number 3 on our list of assets is industrial commodities, raw materials. Industrial commodities, encompassing a range of raw materials, play a pivotal role in global economies, driven by their natural utility value. Unlike precious metals, which derive value from scarcity, industrial commodities find indispensability in various sectors due to their inherent properties. Understanding the significance of these materials can shed light on compelling investment opportunities. Key components. Silver. Beyond its monetary value, silver is vital in the production of electronics, medical equipment, nuclear reactors, and various industrial applications. Cobalt, nickel, and copper. These metals are in high demand due to their unique properties crucial in diverse industries. Cobalt, for instance, experiences surging demand for its role in producing batteries for electric vehicles, leading to a notable price increase. Investment avenues. 1. Mining companies. Investing in stocks of mining companies involved in extracting and processing these raw materials provides direct exposure to their market performance. 2. Mutual funds. Mining. Focused mutual funds aggregate investments across multiple companies in the sector, offering diversified exposure without the need for individual stock selection. 3. Derivatives, futures and options. For those seeking a more sophisticated approach, derivatives such as futures and options allow investors to speculate on the future prices of industrial commodities. Considerations. High demand. Phases. Industrial commodities tend to experience heightened demand during economic growth phases, making them potential assets for portfolio growth. Research and risk. Investing in these commodities requires thorough research. While the demand for certain materials may rise, factors like geopolitical events, technological advancements, and supply chain disruptions can impact their value. Example: cobalt price surge. Since 2020, the demand for cobalt has skyrocketed due to its crucial role in electric vehicle batteries. This surge has driven prices from $20,000 per ton in 2012 to $40,000 in 2022, marking a 100% increase in just a decade. Accessible investment for small investors. Given the challenges of physically storing raw materials, smaller investors can explore accessible avenues. 1. Stocks of mining companies. Purchase shares in companies involved in mining and processing industrial commodities. 2. Mining-focused mutual funds. Opt for mutual funds specifically focused on the mining sector, allowing for diversified exposure. 3. Derivatives. Trading. Engage in futures or options trading through platforms that cater to smaller investors. Industrial commodities serve as tangible assets with real-world applications, making them integral to economic activities. Understanding their role and exploring investment opportunities in this sector can provide investors with a diversified portfolio strategy, leveraging the inherent value of raw materials in a dynamic market landscape. Number 4 on our list is safe haven currencies. In the current world of fiat currencies, where no currency is backed by gold, geopolitical stability is a crucial factor when investing. Switzerland, with one of the world's strongest economic systems, offers a stable geopolitical environment, making the Swiss franc a safe haven asset in times of turmoil. Superior currencies like the Swiss franc, British pound, and Chinese yuan can serve as a valuable store of value. Smaller investors can gain currency exposure through currency ETFs and forex brokers. 5. Sovereign guarantees. Investing in sovereign guarantees provides stability backed by the full faith and credit of the government. Government securities, or GSECs, such as treasury bills, notes, and bonds, offer a safe way to invest in sovereign guarantees. However, the global strength of a government should always be considered, as seen in the 2009 sovereign debt crisis in Greece. 6. Value stocks and mutual funds. While treasury investments provide better returns than keeping cash in the bank, they offer lower returns than stocks. Value stocks, with strong fundamentals, provide steady price appreciation and stable dividends. Dividend-focused mutual funds, such as the Vanguard High Dividend Yield Index Fund Admiral Shares, are ideal and affordable investment vehicles for retail investors. 7. Land and real estate, considered non-depreciable assets, have inherent value due to their scarcity and constant demand. Investing in real estate investment trusts, REITs, allows smaller investors to gain exposure to real estate without substantial capital. 8. Collectibles. Investing in collectibles, such as vintage cars, rare art pieces, or limited edition items, can be a timeless repository of value. Online marketplaces like Whatnot provide opportunities for selling and investing in collectibles. In conclusion, diversifying your investment portfolio with these assets can serve as a robust strategy against the devaluing impact of inflation, fostering long-term financial growth and stability.